The housing market's been a hot topic over the last several months, as many feel like the surging price in homes is another bubble waiting to be popped. If you have been looking to buy a home, then you are probably aware that in certain regions, the pickings are slim, and what you find seems extremely expensive in comparison to home prices just a year ago. Add into this the mix of hedge funds buying up properties, and you've now got competition from all angles. Let's talk about the rising prices in the housing market. Let's talk about hedge funds and their roles in all of it, and let's get to it. What's up YouTube, James from Thursday Media here, and in this video I want to talk about hedge fund involvement in the housing market and how it's making it a pain for new home buyers. The Wall Street Journal dropped an article at the beginning of April introducing the fact that investment firms were buying up real estate, bidding on single-family homes, driving up prices, and making it harder for average Americans to find a new home at a time when interest rates are at all-time lows. The article pinpointed a sale of homes in Conroe, Texas, that was purchased by a single investment firm at a premium. The end goal, of course, was to turn the single-family homes into rental properties. Institutional home buying is nothing new, but it comes at a time when there are supply issues in comparison to demand, and casts a spotlight on how funds can easily outbid young home buyers out of properties that they could have otherwise afforded. But one thing new home buyers can't afford to do is hit the like button so that YouTube knows that we're still in the game, and follow us on Twitter if you want to keep up to date with things that are going on in the channel. Now, the dramatic rise in housing prices and housing demand is a little bit more complicated than a bunch of hedge funds going out and buying up all the properties. Government policy, low interest rates, and a shortage of raw materials are all factors playing into a lack of supply and driving up prices. I remember last year during the initial pandemic dip in the market, there was a tremendous amount of uncertainty when it came to people's houses. It was at this time that I took a risk and invested in retail housing REITs under the assumption that the housing market would likely bounce back under low interest rates. So I want to be transparent that I do invest in companies that purchase residential properties, specifically in the New England region. What I didn't foresee was the extreme rise in prices due to the many other factors driving families to buy real estate. Which brings me to hedge funds and investment firms using their very large financial reserves to outbid average Americans just trying to buy a home, and it's creating several headaches. Funds are making the case that real estate is not only worth its current price, but they're expecting it to grow, or at the very least pay for themselves in the short term. Unlike in the previous housing bubble where loans, and especially bad loans, were given much too easily, in the current market environment, banks have tightened up their purchasing requirements, and even more so in the last several months. This is leading many to bet on the housing market to remain steady and home prices to continue growing in price until interest rates begin creeping back up. And this isn't the first time that we've seen this type of activity either from hedge funds. In fact, following the 2008 financial crisis, there was a substantial number of foreclosures across the country, and investment firms were swift to take advantage of the opportunity. Blackstone's startup Treehouse was at one point spending $150 million per week buying up properties. These, of course, were turned into rental properties or sold once the value had substantially risen. Now, investment firms buy properties all the time. What makes this situation so tough is the low supply and where and which homes are being bought. The country and its industries are changing, with big tech and business shifting away from California and the Northeast for states like Texas and Florida. Institutional strategy is shifting along with it. While we likely won't see large institutional buying in rural areas, growing urban communities and suburban areas are seeing the brunt of investment firms buying and renting homes. The houses that they are targeting specifically are affordable middle-class homes and are properties likely to be bought by stable middle-class families or first-time home buyers. And the results are as you'd predict. Investment firms are outbidding retail buyers and scooping up properties in high-growth areas, basically cornering the market on affordable housing for middle-class workers in these cities. This is, of course, elevating all of the housing prices in those areas, but hedge funds aren't interested in flipping high-end housing. It just seems more like a tactic to force as many people as possible into the cycle of renting. Rent, which can be incrementally raised to adjust for inflation. There's still a lot of concern about inflation, despite the Fed's optimistic view about the massive stimulus injected into the economy over the last year. Now, maybe it will all work out according to plan, but if we see higher than expected inflation, stocks will take a hit. Real estate is generally an asset that increases in value over time, and one that's considered a hedge against inflation. This isn't to say that people should copy what hedge funds are doing, as hedge funds have many different kinds of assets and specialize in stocks, but it's a detail to pay attention to. If you are a follow the money kind of investor, pay attention to the housing market because it has been a go-to for big money for years. And if inflation is something they see in the future, we can expect even more money moving into real estate before interest rates go up. We'll see the effects of inflation more towards the end of this year, as company earnings will reveal if higher costs are cutting into profits. If inflation goes up, we will expect the Fed to raise interest rates, which will cause housing prices to take a hit. If the Fed is right and inflation remains stable, then we can expect housing prices to stabilize and remain at these elevated levels, even as supply catches up. However, if you're in one of these highly sought-after markets, a cooling off of home prices may only occur once supply and new construction catches up. But we may not see a major price correction anytime soon. In these growing communities, institutional buying may keep home seekers stuck in the rental cycle as home prices in their area remain out of reach. If you're lucky though, you may find a gem that gets overlooked in the middle of the bidding war. But as always, I am not a financial advisor. I'm just a regular guy with a regular job, just hoping everyone nabs the home that they want while interest rates are low. So always make sure that you do your own research before making any financial decision and that you make financial decisions that you're comfortable with. If you're interested in investing in something like REITs, I'll leave you some links down in the description below that'll help get you started. Some of these are even offering free stocks when you sign up and make your first deposit. If you like this video and you want more like it, make sure that you subscribe to the channel. I post every Thursday and Sunday unless I throw in a bonus. Watch the markets carefully, follow the money, and thanks so much for being here, and I'll see you in the next one.